All right. Good morning, everybody. Hope you all had a good Wednesday, made it over hump day. Another week drawing to a close. Another month drawing to a close. As expected, Fed cut 25 bips to their weird range now. Not 4%, not 3.75, but a range, which they've done since the GFC. Announced an end to quantitative tightening on December 1st amid moderate economic growth and persistent inflation. Chair Powell's cautious comments on future rate cuts and tariff-related inflation risks prompted a sharp decline in cryptocurrency markets. Very nice news. Whatever. That doesn't really matter. None of this matters in general terms for Bitcoin. But he did say, don't necessarily expect another cut in December. Although I think the markets expect it. As you know, I like to look at trends. All right. Exponential on log is always a straight line. Okay. Sometimes the long-term trends can actually turn out pretty interesting, as is the case here. And this is actually only until the end of the gold standard. Okay, this is from when the Fed opened their doors in 1914 to the end of the gold standard in 1971. So it's only here. All right. See the obvious big two bumps in World War I, World War II. Although I've said many times, this is not indicative that the Federal Reserve paid for the United States coming into World War I relative to the Treasury bonds issued at the time. The Fed owned 1%. I can show you that chart again later. But as a percentage of total treasuries here, it was higher, and it has been about that high ever since, if not higher. 10%. 10% the Fed owned of bonds at this point. Now it's about 18%, and they have room to grow up to get higher. But anyway, this is an old trend. Interestingly, slices right through where we are today. Without doing too much of the history, the 1971 trend, all right, was where this is really an important thing. Okay, I really do think so. So this is the black line's the old trend until this date, and then it just projects out. This 1971 trend is just remarkable. Everybody in the world, certainly in the Western world, thought they had it figured out at this point. Look at that R squared. 100%. It's not really 100%. It rounds to 100%. It's 99.9 something. Or 8. I'm not sure. It doesn't really matter. Rounds to 100%. So basically, you increase the balance sheet. This is total balance sheet, by the way, which is mostly the monetary base, but on the asset side is the treasuries that they own. You increase the balance sheet by 6.7% per year. And Bob is your uncle, as the Brits say. Weird phrase, but that's what they say. Only little real blip was here, Y2K. They printed more money to prepare for that. But then, of course, you had the wacky newsletter writers like Gary North bury a tractor, anti-Semite that he was with his Nazi Holocaust revisionist story. Got to be careful with those newsletter writers. If I can give you one message and to try to take away the mail-ox, as Keynes said, I'm not a Keynesian, but markets can remain irrational long after you've run out of capital. Paraphrasing. Every talking head in the world today, including Peter Schiff, although Peter Schiff has rightly been against a lot of this most of his life, would have told you that this is just the way to do things. You increase the balance sheet by 6.7% per year. Dollar's a strong currency. America has all the guns, even during the Soviet times. It's almost like we figured it out. Right? And this even actually even held into the 60s. I could draw the trend line longer, but I just kind of arbitrarily did it. Not necessarily arbitrarily, but you know, it's a different monetary epoch here when the U.S. had to close the gold window. Then, of course, we see a very different world when the financial crisis comes. All right, so if we do that trend, it's here. Totally different. It's faster. And even faster than this one. It's a little bit weird, right? It's kind of like the national debt story is kind of. But unlike Jeffrey West's super exponential growth, which is faster and faster every epoch, the Fed grew their balance sheet pretty quick during the Great Depression times, World War I, World War II. Right? And they grew it much slower in the 70s, 80s, 90s, 2000s. But now we're in this new world, this post-Ben Bernanke era. Where everybody knows they're going to do something if economic data is bad, but you know, they've thrown everything but the kitchen sink at problems in the economy should they have arisen, right? And you know, we did not have hyperinflation of prices here because they actually stopped banks from lending out too much of this money with interest on reserves, which I can show again. I've shown charts of that before, the interest on reserve rate. Here, during the early 2020 craziness, they did put a lot of this into the economy, and we did have inflation, price inflation. Now it's coming back. But anyway, Powell said finally they're going to stop shrinking the balance sheet. All right, and they have plenty of room compared to historically. All right, so eight out of 10 newsletters you write are going to say the dollar's going to zero, the world's going to end, and buy gold and buy my newsletter, or you know, the Bitcoin version of that. The reality is, spend some time with your family. Try to not freak out too much, because this stuff can go on for a lot longer than you think. Let's see how high it could possibly go. All right. Let's look at the 1971 trend, which admittedly is much slower, and I think we're never going back to, personally. Right? The Fed's been trying to normalize their balance sheet, by the way, for 15 years. They haven't normalized it. This is normal. This is a normal level. It's a $3 trillion balance sheet. What do they have now? Well, the trend is 9. They are below it. It's true. Back to 6.6. Always reverses around the 666 numbers. Same thing with the S&P in 2009. Anyway, we could maybe say the 1971 trend, or I guess I could put the all-time trend, but whatever. When all is said and done, it's probably not going to be as fast as the red line. It's certainly not going to be as slow as the blue line. But let's just project out. Let's go out to 2050. Let's see what it says. $83 trillion. If you follow the 2008 trend, 15 trillion if you follow the 1971 trend. I'm pretty sure it's not going to be either one of those, but if you think that 83 trillion is impossible, it's just not impossible at all. It's simply exponential growth. The Fed was up to 9, although they didn't hit 9. It was a boogeyman number. In 2022, they didn't want to hit it. They got up to $9 trillion balance sheet, 8.99, whatever. Now they're down to 6.6, and they're going to turn it around. They're going to print more. So they will. Trump wants it. Presidents always get the interest rates they want. It is absolutely within the realm of possibility that we get to a 80, $70 trillion balance sheet by 2050. Even with Bitcoin in existence. I'm not saying that's the only future, but this stuff can go on a long time. If we look at, say, during 2 world wars, how fast they were increasing it, which again did not count any of this moderation period. It's 47 trillion. All of these, I think, are decent ranges. Not this one. Not the great moderation. They're never getting back to this. It's not happening. So, there you go. Good morning, Daniel. Good morning, sir. I do. And I can show you this stream, no problem at all. But I want to keep looking at the exponentials because it's going to maybe take away the fear or take away the uncertainty. Everybody says, oh, it's great that the Fed's reversing it and Bitcoin price is going to go up. Okay, it might. Bitcoin price also went up right here when the Fed's balance sheet was going down or sideways. They didn't print money at all from the first top in Bitcoin, major top, which was here. Okay, they printed a little bit more. But then they said they didn't print money at all for 3 years. And at the second major top in Bitcoin, which was 8 years on of its life, they were just starting to come down in the money printing. The stars aligned here. It's true. Everything pumped here. But it did not happen here. I'm talking about the Bitcoin price. It did not have to align with money printing. Having said all that, the power trend of Bitcoin is the most important thing to keep looking at. Okay, so here's the Fed's balance sheet. I want to revisit again what I talked about with the gold price because gold's going crazy. Peter Schiff's going to say a lot of stuff, and he has been saying a lot of stuff. Although I don't follow him, I don't really care. Unlike the charts that I've shown a little bit before, I'm going to show you the long and the short and also the most extremes, not to have too many lines on this. So, again, gold, just like the Fed's balance sheet, it's a straight line on log scale. Bitcoin does not do that. Okay, so gold is a straight line on log scale. Take the slope of the trend, you get a 5.3% CAGR. That's what gold has done since it was untethered from the dollar. Not amazing, but, right now, we're bumping up against literally the highest observations ever recorded relative to gold's exponential trend. That's an important point to say, relative to gold's exponential trend. Okay, so this is now 100. I used to show this like 97.5%, which is like 2 sigma. This is whatever, I don't know, 5 sigma. It doesn't really compute that way with percentiles. 100% of the time, the price will either be at this red line or below it. Okay, and it can pull it higher, right? It can pull it higher like it did here, but it's very rare that it's not going to do that forever. Once you set a new high, it's in. And obviously, this is not even like that out there. This is early on, 10 years in, so no one knew where it was going. This trend is going way higher than the price at the time. This line didn't exist at the time, but just to show you, that's the growth of the exponential trend at 100 percentile sort of multiple, which is two. Look, there it is. The multiple will stay fixed in this calculation. So 2.54x. It's never been higher than that over the trend. 2.54x. Here's the long-term trend. This is where we are. All right, so we're getting close to 2.54, the trend, but we are not at 2.54. Whatever, I could just do it for you. We're at 2.05. 2.05 or 2.04. So we got room to go. But as I showed you yesterday, we can do other trend line analyses and really give us a Peter Schiff curve. Let's embrace it. Let's see how gold could go in the short term if we just assume like the best R squared we can get, which is here. Not even here actually, but here. I tested it. It'll be here. It's great R squared. 97%. So in the last 2 years, this has been a great trend line for gold. It's also a massive CAGR. Look at that, 41%. This is like a Bitcoin CAGR. I changed this slightly because it used to be to here, but anyway, it has to do with the weekly closes. Doesn't really matter. It's close enough. All right, so let's now assume that gold stays on this short-term trend. What's the max the short-term trend has done? Well, it's going to be much tighter because there's not much data. Right, so no one knows for sure. But we got about a year, actually not even a year, 6 months before we bump up against the long-term trend. Okay, so that's going to be interesting. And we'll have to see. I have no problem with gold, but it is true that right now, holding gold in dollar terms will give you the same CAGR as holding Bitcoin, at least on a trend line basis. So it's pretty interesting. Now, I highly doubt that this is going to continue. All right, so here you go. We get to, if you go all the way up to 2050, you get to $20 million gold. This is where Peter Schiff would just love this. But if we stay on the all-time trend, $7,000 gold. So I'm not a financial planner or advisor or trader, so you're just going to have to, we can keep revisiting this. Something tells me this is not going to hold. But we have about 6 months to see if we'll bust through this long-term trend line. And when I say long-term trend line, I mean long-term extreme, like the most gold has ever been relative to its long-term trend, which is 2.54x the trend. So we'll see. Good morning, MP. Good morning. Welcome. As we talked about yesterday, gold's relative to, confined by the laws of supply and demand. The cure for high prices is usually high prices. If you're a consumer, so too high of prices will bring in other people to compete in that industry. The additional competition will add supply. The added supply will bring the price down. Bitcoin does not have that constraint, by the way, but gold does. Just like everything else in the world, gold follows, those constraints. It seems very unlikely to me that we get on a 40% CAGR anytime soon for gold, like long term or midterm. Again, going back to the Fed max since 2008 has been a 9% CAGR, right? 9% per year. Exponential trend, so it's a straight line on log scale. Remember, a 10% CAGR will double every 7.2 years, so a 9, I don't have it in my head, like double every 8 years or something. 8.5. And the Fed will keep increasing the balance sheet. So that's gold. And now I wanted to do the market cap, because we talked about these yesterday. The numbers get really goofy if you do this, not just in price terms, but in market cap terms. So again, here's the long-term trend, which, by the way, interestingly, is a different CAGR than the price itself. All right, so the price itself, 5.3% CAGR. But since you have more ounces of gold coming out of the ground, the CAGR on the available gold is higher. It's actually price plus the new gold. So it's a 7% CAGR. All right, and these are in $1 billion. So 1,000 billion is a trillion. Here's where we are today. $23 trillion gold market. This is available gold, doesn't include industrial gold. Trend line is 12, all-time trend. And getting to this, stretch it to the limit would be 28. Doesn't mean it can't go higher than the limit. I'm just showing you the limit relative to the trend. All right, so now let's look at the short-term trend. This crazy trend, like crazy Peter Schiff, like let's go crazy trend. All right, it's much better fit, as you see, 97.7% CAGR, 40.7% CAGR on the trend line. Similar, this one will take a year to pass the all-time. Last time it would take how long? Less than a year, right? Actually, about the same. A little longer, in fact. Anyway. And then the extension, that's like max, at least for this short-term trend, would be by June. So whatever, 8 months out. But then we have to sort of think rationally about how this stuff looks. Say by 2050, this trend line looks absolutely insane for gold, right? So 65 trillion on the long-term trend, that seems totally doable. That's number one down here. But number two, which is the Peter Schiff trend, is a new financial system. It does not compute, basically. That's 100 quadrillion. So this is why it's good to look at this in the market cap perspective. This just is crazy. This is more rational. Makes more sense statistically. Anywhere from 65 trillion to 155 trillion in the extreme, versus this short trend, which is, being very favorable to Peter Schiff, the 2-year trend. I doubt it's happening. Never say never, but statistically it looks pretty out of the ordinary. Here's another reason why I think this gold is stretching right now and very high to being overvalued. Besides the Bitcoin priced in gold chart, which I'll show you in a second again. But another reason this is just, besides it looking just so odd and extreme, is let's look at the stock market. Also, here's the S&P. Let's be very favorable to the S&P. let's take it from again when the gold standard ended, but this was like a big dip. So let's just pick the bottom, the worst price to catch all the recoveries, .com, boom, bust, GFC, everything up until today. Pretty good trend, 96% R squared, 8.6% CAGR. Right. A little bit elevated. Maybe we fall back to trend. Let's look what the GFC did. GFC took us to half the trend. Trend was 1400 on the S&P, and it went to 666, but this is a weekly chart, so I still don't catch the 666. I got 712 here. Okay, so let's take the 0 percentile off. Now let's look at the short-term trend, and the best short-term trend is here, right? Reasonably, right? Reasonably is from the GFC, and it's 11.8% CAGR. All right, so here's a reasonable change, and it's possible we can set in on this trend with inflation, even with inventions like higher productivity, AI, whatever. It's possible we can grow faster than we did before. I know people think that's like not possible, but it totally is. In fact, that's what super exponential growth is over time you grow a bit faster, even though you're still on an exponential trend. So let's see how long it would take to cross. 2036. This seems more reasonable, right? I mean, it's, no one knows, but S&P at 1300 on the long trend, or 20,000 on the short, which would also overcome the longest 100th percentile trend. And even if you go, like, we can go even quicker, let's say, if S&P goes to its absolute max on the short-term trend. Let's just take off this. Now you just have the most extreme versions. Still would take 6 years to pass. And we may have a huge drop in between, by the way. Looking at the shorter side might be more interesting. How low can we go on the S&P? And look, I mean, it all depends on where you draw the trend line, but going back all the way to the 70s, you can see that both the .com and the GFC like very quickly charted new territory to the downside. Could that happen again? Yes. Maybe it's long enough where this can be a support, but that's pretty wild to see. Anyway, if we think of what could happen, or if the S&P starts to break down, right, it's getting close to 6,700 right now. It might be actually, now I got 68.90. Right, yeah, 68.90 on this is a weekly chart, right? So maybe it could break down somewhere here, 5,000, and if it goes below that, maybe 2,700. So there's your idea. A half, 50% down, or 75% down. The idea is just to show you that this stuff can go on a lot longer than you think. And, you can clearly see this is exponential growth for the stock market. Now, let's look at the most extreme moves. These will be the most extreme moves to the upside. Most extreme. .6% CAGR versus 11.8% CAGR. That's what we're looking at, basically. So some people like stocks. Some people want to stay vested in stocks. Fine. Bitcoin's still better. Let me know if you want to see something in particular, guys, but I want to show you. Okay, now I'll show you how Bitcoin compares with all these CAGRs. Fed, 9.1% per year. I think it's a good number to just keep in your mind. 9%. It's what the Fed does. If the Fed, in general, increases their, even though they do it like in really weird, centrally planned, awkward movements, the trend line growth of the Federal Reserve is 9% CAGR. So if the Federal Reserve is increasing their balance sheet by 9% per year, you should be increasing your balance sheet by 9% per year. Full stop. Don't worry about what they say inflation is. Just do that. Same with the S&P. S&P shows that you got to be growing even a little bit quicker since the GFC. 11.8% per year. Keep that in mind. We'll come back to gold. But here's what Bitcoin has done over the long term and based on the power curve. So again, I've said this 1,000 times in case you're new here. Power curves are not straight lines on log scale. And the power curve is the only curve that fits Bitcoin well. Right? In fact, it fits it remarkably well, and the price has remarkably fit around this curve in the last 2 years. But if we look at the just smooth return on the regression trend line itself over trailing 12 months, we were hundreds and thousands of percent at the beginning of Bitcoin's life, and now we're running down to this 42% a year. Still a monster return compared to anything else, except for gold right now in the last 2 years. Still 42% per year. That's a doubling every 2 years. It's monstrous. So the question, an interesting question, is how much gold will bounce or keep bouncing. I would say highly unlikely that this trend holds, just based on the all-time history. You never know. It could be a situation where we look like this, moving into sort of a new monetary epoch, more and more money printing. Maybe this 100th percentile gets pulled, way up for a decade, maybe. But it doesn't seem like it will hold at this angle, which is an insane angle in any market. I mean, 41% CAGR per year is it's astronomical. That's an astronomical return. And what I still think is more likely is we can use the gold power curve, as I've shown you guys many times, to guide us, gold in Bitcoin terms, Bitcoin in gold terms, to guide us on how high Bitcoin, to guide us on how high Bitcoin can go versus how low it currently is in terms of gold. All right, so I'll show you what I mean. All right. And notice, by the way, on this curve, how the extremes, the 0th and the 100th, which I was showing you for gold, are really so rare anymore. Right? These were like 10-year ago moves or 12-year ago moves. It's much more likely to be something here. And we are seriously low. Yet still, 27.5 gold ounces per one Bitcoin. This tells us a lot, in my view, about what's happening and what's going to happen. Because the Bitcoin curve, the fact that this chart is curved shows you that Bitcoin is more powerful than gold. Although, it's true, gold relative to its prior trend in dollar terms is going at a gangbusters rate right now. Basically the same rate as Bitcoin, 41% per year. And this is even a stronger trend because it's exponential. It will stay at the same rate. But I think this is just a short term. I mean, this just doesn't fit. Peter Schiff would love this idea, but it doesn't make any sense relative to everything we know about Bitcoin. But anyway, to further flesh that out and to see what makes sense, you only have to go back 2.5 years, 3 years to see 9-ounce Bitcoin. That is 9 ounces of gold per Bitcoin. And even as poor as Bitcoin has done versus gold, you're paying 3 times more at the moment. This is a major governor, I'd say, in the price of gold. And gold bugs are going to see right now, I think very soon. They're going to very soon see how cheap the price is right now, and I don't think it's going, let's say, much cheaper. You know, I do my disclaimers, never say never. But someone's got to tell me, someone's got to give me really, really good reasons why, you know, this metal that can't easily be transported. Yeah, it's shiny. People like it in India and China. But why this metal is going to continue to outperform Bitcoin, especially on Bitcoin's power curve, which is, as you see here, 95% in terms of gold, 97% in terms of dollars. Seems highly unlikely. I think I'm talking too much. Anybody want to see? I mean, look at this. You'd have to go back to the the start of the silly season. That's the term I'm just going to call it. To get back to 3-ounce gold price, never seen again. Not even close. Not even close. March 2020, 3.5 ounces of gold as the world was freaking out and ending. 3.3 ounces of gold. Does anyone seriously think Bitcoin will, in the near future, be worth 3 ounces of gold again? Anything is possible. And in the very, very, very short term, anything can happen. But trend lines are there for a reason. I mean, it's just a statistical ballpark that you're creating. And, you know, how likely is it that you'll be in this seat or that seat is what we're trying to say. And it's just extremely unlikely based on this trend that we're going to get back to even 9 ounces of gold. And if you look at where the 10th percentile is, literally right now at this day, it's 22 ounces of gold. So let's make it simpler. Let's take off everything in between the 1 and the 9. Okay. We crossed the Rubicon here, 1-to-1 in 2017, early 2017. This is the chart that Peter Schiff can't explain. March 2020, we're at 3. Post scam bankman fraud revelations, we're at 9. And now we're 3 times that, albeit very low on the trend. This would be really exciting if Bitcoin reverts to the mean here, because it means double the dollar power curve. Dollar power curve by year end is going to be 125K. We revert to the mean here. Gold price stays the same. That's 250K. Because we're half the gold trend and we're right on the dollar trend. This is probably the most exciting chart, frankly, for Bitcoin that I can think about. It never means it has to happen. I mean, it could go 5 years sideways still versus gold. I don't know. I'm just showing you probabilities. And let's look at the 50th percentile. Let's take off the regression, which is mostly the mean. It's not exactly the mean, but it's very close to that idea. Here's the median. All right, so if you look at all 6,000 days of gold and Bitcoin price history, number 5 is smack dab in the middle, the median. 50% of the time, the price will be below the 5. 50% of the time, the price will be above the 5. The median by year end is 40 ounces of gold per Bitcoin. 40 ounces. That's a strong trend. Good morning. And yes, I think so. I think it's very bullish. I'll show you guys in the dollar chart now so you can sort of understand. I got to pull it up. But this chart, now that we have Bitcoin, I think we can sort of temper our expectations about this chart, which is just, I'm happy to show charts that Peter Schiff would like. He would like this. He would absolutely like $100,000 gold by 2035. The long-term likelihood says max $8,000 gold. It could prove to be too low. I mean, we'll just have to see. Maybe we split the difference. I don't know. $20,000 gold. 40. But this is the best that I can show you as far as the numbers go. All right, so dollar terms again. Let's do the same thing. That is 10th, 90th, and median. Okay, so just like the gold, Bitcoin, now we got dollar, Bitcoin. So the first thing you should notice, in gold Bitcoin, Bitcoin's super cheap, right? 20th, 30th percentile. In dollar Bitcoin, relative to the median, we're a bit high. Relative to the median. Relative to the trend, right on it. Slightly under. Trend is your friend. But this is what I'm saying. If gold price stays the same, Bitcoin reverts to the mean here, which is really here, then we double versus what we see here. All right, so it's not just the trend at the year end, it's going to be double that because it's so undervalued in gold terms. It's going to be like 250K, which is the 90th. We'll hit the 9. Yeah, so it's a good question. You know, my thesis has remained the same. I got to show you the chart to pull it up, but um, if you look at all the base money in the world, Bitcoin is 10% of that. So I would say that economics, money printing, interest rates, politics has 10% to do with what Bitcoin does. The 90% of it is this. It's just the curve itself. It's the nature of Bitcoin. It's the nature of Bitcoin. So this one I haven't shown in a while, but it's not that complicated, but it's just if you take silver, gold, and the monetary base, value's 40 trillion. So this will show you even Bitcoin's even less, right? If you take silver, gold, monetary base, Bitcoin is 5%. And these numbers will start, I'll get more numbers, better numbers by the end of the month, but they're not going to be much different in here. We'll have a little bit higher base money, assume, but actually 45 trillion is the figure, 45 trillion. All right, so 5%. This is what I mean when I keep saying that Bitcoin's only 5% of, 5% of, or 10% max of the real economy has anything to do with this curve, which is so unbelievably massive and strong and just a freight train on its own. And this curve is important too, right? I mean, that's why I measure these things. Like, this is an exponential curve. We're blending things now, so the CAGR here is like 7.5%. We're blending gold, silver, and fiat-based money. That is central bank balance sheets. But they don't hold a candle to what Bitcoin does in growth. So here, it's going to be a little bit longer than base money alone. We'll take, probably 2043 to pass that. And 5 years before that, we should pass fiat-based money alone, not counting gold. Of course, the gold trend that I'm using is kind of a blend of these two, actually. I'm taking the gold trend back to here, so it's different. Regardless, we're in the trend that I'm using, or this trend, we can see gold is way over trend. It's double the trend right now. It's pretty wild. So we'll have to just see how long this keeps up. This, in my view, is going to be your, like this will be the first interesting point as we cross here next spring. If gold's still going gangbusters at 40% per year. And then the next one would be the trend line itself. Yeah. which is going to, the trend line itself over the sort of red hot line of the long-term trend. Take a little bit longer. Late next year. We'll just have to see. But I suspect that this is way fast. Like this, it's just not unsustainably fast for gold. And this chart to me is unbeatable. We'll just have to see. But for every day, theoretically, based on the trend, every day that gold, let's see how fast it grows. I keep forgetting. November 23rd. I'll show you what I'm looking at right now. Just look at 65 ounces there. November. The week of, no, this is daily, right? So November 21st, it changed from 64 to 65 ounces. Let's see when it changes to 66. It's like 2 weeks, 3 weeks. So every 3 weeks, according to the trend, which it's true, we're way under trend right now, but the trend tells us that every 3 weeks, it should take 1 more ounce of gold to buy Bitcoin. That's true. We have not even hit the trend line this cycle. It's pretty wild because of gold's massive performance. But, you know, just like I said about the 4-year cycles, I'm not calling them over until it's over. I'll do the same here. You know, we're going to have to see. Next 3 months going to be really, really interesting. I don't know, man. It's too short term for me. I'm probably the wrong channel for that. I wish I knew, but this is why I like the longer, midterm, longer trends. We can just sort of relax on where we are and where we've been and where we're going to go. Because if I told you something like, according to this black line, at the moment, and it's true, this will change over time, but at the moment, it only takes 3 weeks to add on another ounce of gold to the Bitcoin price. That would make me think twice or 3 times if I was a gold bug of holding gold relative to Bitcoin. But then again, you go to this chart versus the dollar, and gold is just absolutely going gangbusters for 2 years. There's no disputing that. So you could hedge your difference. You could do this. I'm not. This is a coincidence, by the way. It's a Bitcoin gold fund. The guy gave me this in L.A. from, I guess, what is it? Quantify funds. I don't own any. I have nothing to do with the company. I'm just wearing the T-shirt. You could hold gold and Bitcoin, and they're both going gangbusters right now. That's for sure. But with everything I know about the math of this stuff, like, this is sort of out of this world. And you can see that by the S&P. Where's the S&P? Even the Fed. All right, again, look at the Fed. It's growing faster than the prior 50 years, but not that much difference. I always miss my charts. Where's the S&P? Here we go. S&P as well. 3 percentage point difference based on short versus long term. Clearly the short term's a better trend here, obviously because I'm catching the lows of, you know, but it's been pretty good. The trend is your friend. Keep following it until the end. Get your trailing stops in. But this one with gold, it's just wacky. Peter Schiff's going to sell no shortage of products and emails, newsletters, whatever. Taking advantage of this. I don't know if he's drawn this trend, if he understands any of this, but trying to be fair to all sides. It still seems very unrealistic that this continues. What else, my friends? You can check in on some other yeah, I really want to get this done. I showed this before. And again, feel free to correct me here, but from what I see, which is another reason why 100K is a very big mental barrier. You know, 5.5 million coins moved. Although I do have some questions with those numbers because based on this, the 100K threshold is here. And he doesn't have anything in the purple, which definitely moved in July over 100K. Right? Or was the price not over 100K in July? I just got to find this out myself. Yeah, it was. It was. Remember, it was July 4th when the like 80,000 coins or whatever moved. And it's something about the UTXO set. It's everybody has a different UTXO set, but he does not have any purple coins moving here, and they absolutely did move. So it's even more, in my opinion, moved over 100K price. But it's interesting. I mean, a lot of coins have been moving. A lot of absorption of old money. And in my opinion, even older than this chart suggests, have moved over 100K. So I want to get some more charts like that for you guys. Shoot. Let's go here. Show you one more. And let me know if you need any other charts here, people. But Here's U.S. money supply. This is such a lagging indicator. Like I actually have it going up to M3, not M2, M3. But it's so lagging by the Fed, I won't get it till like November to give you even September's data. But it's going up massively. All right, specifically repos, which by the way did trigger a financial crisis, but only when they started to collapse again. So here's just repos. All right, so again, repos just like fast trading treasuries. It's levered up treasuries. It's where like a money market fund says, okay, if you're going to repo with me, you give me a little bit more interest than I would get from the treasury itself. And the hedge fund, which is on the counterparty, which is doing the repoing, the money market fund does the reverse repo, which is an asset. You count up the repos, which is the liability, which is the hedge fund's liability of said treasuries. Say, yeah, I'll pay you more. Just give me the treasuries so I can or give me the collateral of the treasuries, in my account, so I can short and long stuff and do different stuff. So the point is, you can clearly see that before the GFC, these went to really stretched levels and then crashed, and they're going to stretch levels again. Notice that the Fed funds. So this is kind of like bank reserves for non-banks, for money market funds primarily. So during the silly season, scary times and lots of inflation, the Fed did what it did just before the GFC with bank reserves, which were here. But I'm going to take that off. It said, okay, you money market fund, don't lend out all your excess cash to hedge funds to do crazy stuff. Just park it with us, with the Fed. And what you see is that it kept that number 7 suppressed during the high inflation days, right? But then they tried to normalize. They say, all right, we can't do this forever. It distorts the market. So then you can see it go right back into the market. See it? We go from 4 trillion or even less than 4 trillion in repos. Now we have 7 trillion outstanding and probably rising. This is an indicator of a possible crash. But the problem is I can't predict it before it happens, especially because I don't get the data in time. It's too bad. It's another wonky thing that the Federal Reserve does. The Federal Reserve stopped publishing M3, by the way, back here in February 2006. Right there. And notice what conveniently, these are the 2 big things that are hot money as far as M3 goes. Notice what conveniently kept rising just before the GFC, and the Fed wasn't publishing it, and then crashed after the GFC. So that's interesting. And these are rising. So warning signs for sure. I mean, you can clearly see relative. I could draw trend lines, but you clearly see that they're going up faster than like the time before it. Bitcoin purists or people that tell you the dollar's going to zero. There's $37 trillion that are reflected here in the total money supply. The value will keep eroding, but it's not going to zero anytime soon. So this is what I mean, going back to the top of the stream, I think Bitcoin allows us to not have too many Malox moments. It can be counter-cyclical. It can go up when they're not printing. It can go up when they are printing. And they're going to start printing again. This is what I wanted to show as well. This is how much theoretical room they have. All right, you need to look at how many bonds the Fed owns relative to the total debt of the United States. I need to do this for other currencies. I know people have asked, but it's coming. It is coming. So this is another thing that Powell said he's basically going to start reversing. It's the entire history of the United States debt, also with the Fed. As I said at the top of the show, Fed did not really contribute to World War I, even though they did have a big bump in their balance sheet. That was 1% of the total holdings of, or the total issuance of war bonds, government bonds. It did change during the Great Depression, and it did change during World War II. Not actually even during the thick of World War II. Notice that, by the way. Well, I guess, yeah, they entered the war late, so it did. Getting up to 9-10% was an all-time high, except for the Great Depression. In any event, notice how the Vietnam War ended and this went down, but that wasn't because the Fed was buying any less bonds. It was just debt was going up higher as we went into a full dollar standard. So here's the room that they have. Theoretically, they've been up to a third. The Fed has theoretically had a third of all treasuries issued, which peaked here in percentage and in real terms here a few months later when they were, had close to a $9 trillion balance sheet. Now they're super low again, 17%. I mean, super low in a relative term. Super volatile, super centrally planned. But in my opinion, they can take this as high as they want. I mean, they can take this to 40%. That's going to lose a lot of confidence in the markets, but they took it during a pandemic, during a crisis, they took it to 28%. That is the Fed with printed money bought 28 cents out of every dollar that the government issued was printed. Again, they don't always print all the time. All right, after QE3, it was 23 cents on the dollar, and then it went down. But the point is, they never know what they're doing over the midterm. Like, they usually overshoot. Repo crisis, another crisis goes up. It's super low right now. So we'll see this number turn around. And there's theoretically plenty of room to go up. So you could pay your $20 a month or whatever, $10 a month to a newsletter. Or I could selfishly ask you to tip me a little Bitcoin. Thank you. I hate asking for money, but value for value here. You can also find a lot of this stuff for free on my site. Power curve. Power curve is a straight line on log. You can see it here. You can see all the numbers. These are the same numbers that I show you on my charts, right? All here in table form. Remarkable, by the way. Speaking of how important the 100K Bitcoin price is, that's been the average this whole year. 103,000. It's really remarkable. Power curve will grow 42% it's going to be on a 42% growth rate by the end of the year. Next year, 39, and 37, 35, 33. We'll pass 1 million in early 2030s, probably early 2033 if we stay on the trend. It's a great asset to hold. Let me know, guys, if you want to chart anything else here, but I'm getting a little bit long right now. I'm super interested personally to see how this plays out. All right, with the massive strength that gold itself has, we know central banks keep buying. We know there's geopolitical tensions between the East and the West. This is going to be very interesting for, I guess, the midterm valuations of Bitcoin, as if this reverts to the mean, i.e. goes back to the black line. Because that will put us to a higher Bitcoin price in dollar terms than anybody would expect. To be precise, double. Right? Because we're 50% undervalued on the gold, but we're right on track for the dollar power. And I have a hard time believing that let's count this again. Just look at anything, right? We just changed here 67 ounces of gold into Christmas. All right, now let's see when it switches to 68. 2 weeks, 2.5 weeks, 3 weeks, 3 weeks. Every 3 weeks, the trend says Bitcoin should cost 1 more ounce of gold. Now the price is not actually doing that at the moment, right? It's way sideways to down, but this is a very powerful trend still, 95% R squared, and again, I'm just not ready to count this out until it's, I don't know, forms a new bottom or a new new slope, which it could. It could be the gold was just asleep for the last 15 years. It could be. That's what the markets seem like at the moment. But I have a hard time seeing even 9 ounces of gold per Bitcoin anymore. So I'd say over the next 3 months, we keep track of this one the most. And then, of course, the regular in dollar terms. But these are your levels. And even with this weakness, right? I can't stress this enough. Even with the weakness of the Bitcoin price relative to gold, i.e. gold is just going gangbusters against the dollar, it still costs you 3 times as many gold ounces now than it did 2 years ago. 27 ounces versus 9 ounces. Never financial advice, but I know which asset I prefer for many reasons. And this is a hell of a trend line. Yes, sir. We have Bitcoin treasury companies. There are no gold treasury companies. Right? Gold miners, when they mine gold, they sell the gold. That's not the case with Bitcoin. Unless anybody has anything else, I'm going to leave it here, guys. Shoot me a note in the comments what you want to see, if you want an update on something. I try to just keep it real, not freak out one way or the other, tell you gold's going to 0 and Bitcoin's going to 2 million. Let's just keep focusing on the trends. Focus on your family. Don't stress on the Maalox moments. Don't think too much about this Peter Schiff curve. It seems unsustainable. We'll see. And the Fed grows their balance sheet at 9% per year. And they're bottoming out here. It's already been decided, as of yesterday, that this will start to increase. All right. With that, I will close it for the day. Thanks, everybody, for watching.